Governments all around the world were in a frenzy as they tried to determine the impact of Silicon Valley Bank's collapse, the biggest bank failure in the U.S. since the 2008 global recession, on digital startups, other financial institutions, and even pension funds. But cryptocurrency executives and investors who have had to deal with a very unpredictable market over the last year seized the opportunity to tell the world, "I told you so." As one of the biggest operators of USDC, Circle revealed it had $3.3 billion in reserves backing the token that was deposited with the bank. The crypto market suffered when SVB fell. According to reports, other significant cryptocurrency firms, including Coinbase Global Inc. and Paxos Inc., are exposed to these collapsed U.S. banks. Particularly, it is said that one of the biggest lenders of cryptocurrency is Signature Bank. The SVB crash was considered to be the biggest bank failure ever since the financial crisis of 2008. The 2008 financial crisis was largely created by central banks through their policymaking. Bitcoin was one of the solutions to that dilemma. Bitcoin has the power to destabilize a banking system where a central authority is in charge of making decisions that impact the economic well-being of entire nations because of its decentralized system and peer-to-peer technology. Yet, there are a number of disadvantages unique to cryptocurrencies that make it challenging to argue in favor of a decentralized society based solely on cryptocurrencies. Prior to examining how Bitcoin affects central banks, it is critical to comprehend the function of central banks in an economy. The foundation of the world financial system is central bank policy. Every nation has a different central bank mandate. For instance, in the United States, the Federal Reserve is in charge of regulating inflation and preserving full employment. The stability and solvency of the British financial system are guaranteed by the Bank of England. Monetary policy, a broad category of strategies used by central banks, helps them carry out their missions. They primarily affect interest rates and the money supply, though. For instance, a central bank could alter the amount of money that is in circulation in an economy. Consumer spending increases when there is more money in the economy, which leads to more economic growth. In the reverse circumstance, where there is less money in the economy, people spend less and a recession results. The acts of a central bank also have an impact on international trade, investment, and exports. For instance, high interest rates may discourage foreign investors from purchasing real estate, but low interest rates may encourage such a move. In order to disperse money throughout an economic system, central banks need a network of banks. In this way, they function as the hub of the banking and financial system of an economy, and the decisions made by the central bank determine when economic booms and busts occur. There are benefits and drawbacks to giving a central organization control over an economy. The fact that it increases system trust is arguably the biggest benefit. A currency produced by a central bank is backed by a reliable institution and has a set exchange rate. Chaos would result if each party to a financial transaction produced its own coins, causing rivalry amongst the several currencies. The argument for Bitcoin as a central bank substitute is supported by both economics and technology. Bitcoin was created by Satoshi Nakamoto, who described it as a peer-to-peer version of electronic cash that enables online payments to be transmitted directly from one party to another without passing through a banking institution. Bitcoin addresses three issues in the context of a system of financial infrastructure dominated by central banks. It first solves the issue of double expenditure. Since each Bitcoin is distinct and cryptographically protected, it cannot be copied or compromised. As a result, it is impossible to duplicate or counterfeit Bitcoin. Second, while being decentralized, the Bitcoin network is nonetheless a reliable structure. In this instance, trust is a construct of an algorithm. To be recorded in the ledger of the Bitcoin network, transactions must be approved by nodes dispersed throughout the globe. A single node's disagreement can prevent a transaction from being recorded on Bitcoin's ledger altogether. Third, by expediting the creation and distribution of the currency, the Bitcoin network does away with the necessity for a centralized infrastructure. Bitcoin may be produced at home by anyone with a complete node. Peer-to-peer transfers between two addresses on the Bitcoin blockchain don't need intermediaries. Consequently, the distribution of the cryptocurrency does not require a network of banks regulated by a central body. Yet, there are a number of drawbacks to the economic freedom that Bitcoin promises. The first of these is Bitcoin's use of a transactional medium. There have only been a small number of verified uses for Bitcoin since it was made available to the general public. The cryptocurrency has developed a reputation for being a favorite for shady transactions and a tool for speculation. Second, it's unclear if Bitcoin qualifies as a means of legal transfers. El Salvador is the only nation that still permits Bitcoin transactions, despite the fact that it has been made legal tender there. The infrastructure and users of Bitcoin have been under pressure from other countries, such as the US and China. Ultimately, the supply of Bitcoin is constrained and it is unstable. Just 21 million Bitcoins will ever be mined. The use of Bitcoin is heavily constrained by a restriction on its supply. Cryptocurrency has become a popular speculative asset due to its scarcity. It is challenging to utilize in daily transactions due to the price fluctuations between extremes. The difficulties associated with using Bitcoin haven't stopped central banks from incorporating aspects of it into the creation of their own digital currencies. Some central banks are looking at using central bank digital currencies, CBDCs, as the currencies are also known, into their own economies. A central bank-issued digital currency might do away with middlemen like retail banks and employ cryptography to prevent replication and hacking. In comparison to metal coins, it can also turn out to be less expensive to create. Under the current economic system, central banks are in charge of the contemporary worldwide financial infrastructure. The vast majority of nations in the world manage their economies through central banks. Although it has many benefits, this type of centralized system gives one authority too much power and has led to major economic downturns. The technology behind Bitcoin is based on algorithmic trust, and its decentralized architecture provides an alternative to the established order. Yet, adoption rates for cryptocurrencies are extremely low, and it is still unclear how legal they are. While this is going on, central banks are investigating the possibility of using their own digital currency by appropriating parts of Bitcoin's technology and design. At this point, it is more likely than not that central banks will start introducing their own digital currencies, or CBDCs. As of 2021, numerous nations are at various stages of investigating CBDC potential, preparing to launch their official CBDC, and developing CBDC pilot programs. For instance, the Central Bank of Venezuela intends to introduce the CBDC in October 21 through an SMS-based exchange. And that's the end of the video. What do you think about this notion? Can crypto take over the finance world and potentially replace banks? Let us know your thoughts in the comments below. If you enjoyed watching, please give this video a thumbs up and subscribe to the channel for more content. Thanks for watching, and I'll see you in the next one.